Yes. All right. Thank you, Shane. Thank you guys for joining us today as we go forward. Love to have your questions on the chat box. Just put them in there and we'll answer them when we get a chance. Wanted to appreciate everybody spending their time with us here today. And today we're going to talk about raising a Series A round. And many people are raising funding. And what I find is there's three main fundraisers that people do. There's the seed, there's a Series A, and then there's a later stage Series B or C. And they have very different objectives. And I've had people who are very successful at their seed fail at their Series A because they didn't realize that the objective from the investor's mind had changed. In a seed raise, you're basically trying to convince the investor that you can sell your product and go to market successfully. With a Series A, at that point, they know you can sell the product. And so that pitch deck or that old seed deal you used to do doesn't work anymore. What they want to know is that you can grow the company. And so it's more than just selling the product. It's, do you have the team? Do you have the product roadmap? Do you have all these other things in place? And then if you get to a Series B and beyond, what they want to know at that point is, can you scale the business? Can we go from $10 million to $100 million? And so they're looking for more fundamental drivers that are running behind the business to grow it at scale. So they're very different fundraisers. And while we talk with a lot of people at seed, we do talk with people at Series A, and we have to coach people that it's going to be a little bit of a different game. So in the slides, let's touch on some of the points that you'll come across for a Series A. If you go to the next slide. So the first thing I always like to bring up is, are you ready for a Series A? In other words, do you have a product with revenue preferably above 500K a year? Do you have a growth plan that is going to show how you're going to get from where you are today to $10 million annual revenue? Fundamentally, seed is going from 0 to $1 million. Series A is going from 1 to 10 million, and Series B is going from 10 to 100 million. Your mileage may vary based on what you're doing and what sector or stage you're in, and so it'll be a little bit different, but fundamentally the concept is the same. The first thing they'll look for on the investor side is a very strong team with growth company experience. People who have actually grown it before, not just the seed side, but have grown a Series A company before. Second is they're going to be looking for a credible funding plan. How reasonable are the burn rates on this? Are we way beyond or below what others in the industry are doing? And next is they'll be looking for an updated financial performance showing how you're going to grow from that $1 to $10 million range over the next 5 years or 3 years if you can grow faster. And then you have a pitch deck that ties it all together. It's often the case that we have people coming in with a seed who have done a seed raise and now they're getting ready for a Series A. And what they find out is they really can't get the valuation they want. They've gone out and talked to investors. The investors say you're not ready. And so they often, instead of doing a Series A, they'll drop back and do what we call a seed plus. And that's simply raising another 500K on the original terms. You're doing another seed round in order to get your metrics in place where you can actually raise a Series A or raise a Series A with the valuation that you want. So not everybody who goes for a Series A actually hits it. I would say half the people I talk to who go out for a Series A come back and say, well, we're really not ready. We're going to do a seed plus. We just need 500K and then we'll be in better shape. But the experience is good. They now understand what the investors are looking for. They know what weaknesses they have, and they're ready to go forward with it. Let's go to the next slide. So the next thing that people will look at is make sure you're raising enough funding that you can actually take the business to the next level. And you need to be able to raise enough money so you can actually achieve a meaningful milestone. And so you want to think about how much that funding is to get to the next level. So if you're growing from $1 million of revenue to 10, the funding should establish the core network and team and so forth to do it. But then the revenue from the customers should be taking you on up to the $10 million raise. So you should think about what is that number, and the fundamental team and core, you'll be burning cash for 12 to 18 months putting that into place. But once that's in place, that should be self-sufficient. Customer revenue should pick it up and take it from there. So look at the amount of raise you need to do, and we're happy to talk with you about this as well, because we get a lot of questions about how much do you need to raise, what is standard, and we can actually give you some guidance on that. Let's go to the next slide. So the next one is setting your valuation. You know, the key thing I always talk to people about is you don't want to raise too much money at the early stage. You want to raise just enough to get to the next level. And you can take a large fundraise, and what we recommend do is break it down into smaller milestone steps. If you raise too much money on the early valuations, your valuation goes up over time, and so the earlier raises need to be smaller fundraise amounts. Otherwise, you may be giving up too much. I often hear people say, well, I just want to do one raise for the next 5 years and be done with it. Unfortunately, you would be better off to do 3 raises at much smaller steps. And then as you achieve more sales, more team, more product, you raise the valuation. So you're not raising the entire amount on that low upfront valuation. You're raising a little bit, and then as you get more momentum, you can raise bigger amounts of it as well. So think about breaking the raise down into smaller steps and stair-stepping your way up. Let's go to the next slide. Next question is, you want to make sure that you are matching with what the investor is looking for. So if you're talking to an angel investor or venture capital investor, what they're looking for is a venture deal. And so the first thing they're going to be asking, is this a high growth company? And what we find is 50% year over year growth is the floor. If it drops below 50% year over year, it gets to be hard to sell the investor that you're a venture deal. You're more of a lifestyle business, or there's something not right in the deal as well. Ideally, you're doubling revenue year over year. With COVID and things like that, that will change the model a little bit, and people understand that. But aside from that factor, make sure you have growth rates that show you're in the venture category. Second is, do you have recurring revenue in your model or a plan to get there in a short amount of time? This used to be a nice to have. Now it's pretty much a must have. Investors are looking very hard at getting recurring revenue, if not for all of your revenue, for a good portion of it. So find a way to get recurring revenue in your deal if you don't have it already. Next question they'll look at is scalability. Can this business scale up? If we're doing anything custom or contract oriented, it can be hard to scale. If you're doing things with platforms and you're doing things with online systems, then it's going to be easier to scale, and investors are looking for that. So make sure that's a part of what you have as well. And finally, look for a complete team. Investors at the Series A start looking at the skill sets that are needed to grow it: domain knowledge, sales, marketing, operations, tech. And so you make sure that you have an answer for each of those elements as well. Let's go on to the next one.
I had a question, Mr. Hall.
Yes, Gamma, what's your question?
On the recurring, is it yearly or monthly that they want to see?
Either one works. I think most companies start off monthly just because that's what you can sell, and then over time you move to yearly when people are very well locked in. But either one is fine. MRR at the seed level is very, very standard. When you get to the Series A, they would like to see some customers moving to a yearly model. And so sometimes it's not one or the other, it's both. And some of your customers, newer ones, are on monthly. The older ones are moving to yearly because they get a price discount or they get better service or whatever. As long as it's recurring, that's what they really want to know. And if you have some metrics around, net dollar retention, CAC LTV ratios, and so forth, customer acquisition to lifetime value, this shows that you've got recurring revenue and you're in the game for it, and you're well on your way to improving those numbers as well. Okay, thanks. So as I said before, what you need to have is a platform-based approach. If you're trying to sell one-off products, you can find that very hard to scale. Also, you need to be addressing a large target market, at least over $1 billion. So make sure you're in that game as well. And finally, you need to have a clear competitive advantage. It's tough to raise funding when you're a Me Too company. We're yet another Uber. We're yet another Airbnb. There has to be some advantage in there that says this is how we're going to be successful with some portion of the community as well. So the more of these questions you can answer yes, the easier it is you are going to fit the venture model and identify well with the investor on the other side. Let's go to the next slide. So like I said before, we're no longer trying to convince people we can sell the product. And I often find people pitching a Series A investor where they keep trying to, they continue with that mode. They're trying to show, yeah, we can sell it. Here's how we're going to sell it and so forth. But what you really want to show them is how you can grow it. And at this point, what you're doing is you're looking to show that you have all of the elements of the business, the ability to make new products, the ability to support the products, the ability to sell the product, tech operations, finances, funding, all of the other elements are there to support it, and you're not going to hit the wall. One of the questions investors will ask you that you may want to think about what is a good growth company is, what is your capacity? If you don't raise any more money, what revenue will you achieve before you will hit the wall? And if you understand that, then you're going to be talking very clearly to the Series A investor, because that's what they want to know. Maybe you're asking for $1 million, you put in $1 million. To what revenue will that take you before you hit the wall? You get to $3, $4, $5 million of revenue, and then you can't grow anymore because you need more funding. This is a good number to know in your discussion with Series A, because it shows you understand the systems behind your business. You understand how far you can go with them. You understand what money will buy those systems, and that shows you have a very good knowledge as well. And so one of the questions that came up is semantic difference between grow and scale. So when I say grow, I mean you're going from $1 million to $2 to $3 to $4 to $6 to $9 to $10 over a 5-year window. When I say scale, you're growing from $10 million to $30 million to $60 million to $90 million to $100 million over that same time. So it's just a matter of what the scale on the graph is. And the reason those are two different things is because what you have to do to achieve that is very different. With growth, you have to put in basically very good, solid systems around product development, product sales, and you're just trying to grow the sales. When you get to scale, Series B and beyond, what you'll find is that you have to do things such as grow the market. You have to put in things that can actually give you order of magnitude increase in revenue and productivity. So you're having to develop partnerships, and you're having to do things that are beyond the product in order to create that growth rate that would be called scale, because now you have to get much bigger, much faster, and you're doing different things from the growth side of it as well. So let's go to the next side of it, slide. So funding accelerates what you already have growing in the business today. And that's one thing investors are looking for. Are we putting in money to build something we have never done before, or are we putting in money to do more of what we have already been doing? If you can answer the second question, you'll find the Series A lot easier to raise. And so the thing you want to build is a core process for acquiring customers and providing a service. It's the repeatable, predictable process that is behind your business. When you get to a Series A level, you should have this pretty well defined. It may not be written down, but it's pretty well defined in your business. I've worked for a company once where we had a 3-step process. We went to trade shows to acquire leads. We then mailed to them to come to a seminar. 1 out of 3 of the seminars were then turned into a sale by having an internal salesperson call them up and tell them whatever they needed to hear about configurations, pricing, quotes, etc. And then we had the average selling price then of $2,500. So you tell me how much revenue you want at the end. I'll tell you how many calls we have to make by the internal salesperson. I can tell you how many seminars we would have to do, and then I'll tell you how many leads we have to go. It was a 3-step process. It took 3.5 months, and we could define the cost on each of those steps. So if you can do that about your business, then you have a core process, and that's what investors want to see. They want to see that repeatable, predictable process, and you've got it mapped out and market. You know what the numbers are in time and dollars for doing that. Second is you've found the best channels for acquiring customers, and you've got a good mixture of maybe some high cost, but mostly low cost, efficient ways of doing this. You may not have all the costs wrung out of it, but you've got a good idea of where you can find customers and what they're going to cost you. And then by stating your business in numbers, you now know how to grow it. You know where you're going to have to invest your funding dollars to get it. And that's one of the difference between Series A and Seed. With Seed, you're trying to figure this stuff out. With Series A, you now know what this is, so you can apply your dollars more quickly and more efficiently than before. Let's go to the next slide. So the thing you want to think about for Series A is, are you ready, is to go back through that checklist and see, do you have a Series A level deal, a repeatable, predictable process? Do you have a platform-based business? Are you going after a large market? Do you know enough to say you really understand the growth? You've got product market fit, to grow it, and you want to show it. So the key is you want to have a good, solid understanding of your business, and it comes through on the slide deck to show the growth as well. If we were to do this on a Series B, what you would find is that the pitch deck converts from a Series A to a Series B because it basically turns into a board of directors metrics report. You have key metrics on all the key drivers, and you're actually managing that business at the second and third orders in order to get the growth that goes into it. But that's a presentation for another day. So if you like, let's go ahead and open it up to see if anybody has any questions for us here about what we discovered so far. You can either type it in the chat box, or you can unmute and just ask it out loud. How many people here are actually raising a Series A round? Anybody here in the game for a Series A? Steve, how about you? Are you doing a Series A raise? Or Andrew, how about you? What round are you raising right now? Jami, how about you?
No raise on my end, just listening in.
Okay, great. Just glad to have you with us here. So, see, we have a fair number of people that are raising funding. Gavin, can you tell us about yours?
Yeah, I could be in a little bit of a different situation than other people because we've got a IND drug application in front of the FDA. We do have an OTC business that's doing a couple of million a year, so, but that's not really the driving force behind the capital raise.
So when you're doing a life science deal, I find it's pretty much the same model, but instead of looking at revenue, we're looking at clinical progress, the clinical trials that you're going through. Do you have a good, clear path to FDA on that? So the idea is to, yeah, go ahead.
Yeah, I can address that. Phase 1 and 2 aren't required. LabCorp has taken the drug to the FDA, and they've made case that phase 1 and phase 2 are not required because of the amount of clinical trials and real-world evidence, which is permitted under the IND process. And so we've asked the FDA to go straight to a stage 3 clinical trial.
You must have a very compelling technology for them to go forward with that.
Yeah, we have a therapy for chronic rhinosinusitis, and it's the largest unmet medical need in the USA. So the FDA, just like they did with COVID, are looking at emergency pathways or treatments. They've been looking at chronic rhinosinusitis for about 40 years, and they've not been able to develop a product, and we have. We successfully remove the cause, which is a biofilm. And today, the only way you can have a biofilm removed is through radical cancer tumor-like surgery. You guys know what that is. It's a horrible experience. And sometimes it takes people more than once, and we're doing it with a spray.
So that's very compelling technology then. You can actually make a much more efficient therapeutic and an easier way to deliver. So you must have fairly good clinical data up front, other
amounts, massive.
Okay, so they're using the data that you already have before to get you past clinical trial 1 and 2, because other people have done that already, and moving to a stage that's now going to be more enlightening.
Right.
But so Series A is still kind of the same thing. You have a repeatable process here with the basic tools that you're using, and you're showing that to in this case the FDA, but the investors are watching this, and you're trying to show how this is actually going to work. And so you're going to do a stage 3 test to prove it works, because all the components are working already. And that's the same thing we were talking about for tech companies. They have to go show that their sales work, and their support works, and their finance works, and all those things are working. And now you have to show that together we can actually hit the mark and grow the business from 1 million to 10 million, or from one stage to the next pretty easily, just to demonstrate that we're beyond just selling it to somebody. And so this is a lot of the same analogies that go in there as well. So when do you start your stage 3 trials?
January.
Oh wow! How much are you raising to go do that?
No clue.
Okay.
We're waiting for the response from the FDA on August 12th, and then we'll have a better idea of where we go. I think out of this conversation, what I'm real clear about is we need to bring on a couple of people to really nail down the development work that you're alluded to here in this conversation.
Right.
Trying to do it with the people that we have, that where we're running a business and we're getting ready for a clinical trial is challenging to devote the correct amount of time. Now, I just got it real clear in this meeting that we've got to bring some expertise on board.
That's a good point. Many seed teams are not the exact fit for a Series A task. Some are, some are not, and so you have to start making those decisions, because otherwise.
I'm the seed team here. It's my money.
So
we haven't gone outside yet. See, so I'm the wrong guy to put Series A proposals together, I think.
That's a good point. Okay. Well, good. Well, yeah. Well, thanks for sharing. Appreciate that information.
Carl, I have a question.
Yes, go ahead.
If I may. Yeah. So you talked about doing this like seed plus between a seed round and a Series A. If you're not ready, is there a commensurate in between like a Series A and a Series B? So like, say for example, a client's got, or a customer's got a product, and they want to maybe add some more products to increase their scalability. And but you can't go into Series B with that. You'd kind of work under Series A and try to develop those products and get a good product market fit, and then that could give an investor more incentive when you enter into Series B. Is there? But maybe they need a little bit of money to doing that. Is there like an in between round that businesses typically do?
Yeah, it's the same thing. I've heard it
Yeah.
called A plus. I've heard it called AA, where you raise another $1.5–2 million at the same valuation as last round to get ready to go jump to a Series B. Things take longer. Not everything worked like we thought. There's all kinds of reasons that come into it. Doesn't look out of place. It just looks like what looks out of place is when you start pretending you're at a Series B when you're not, and then when you get into diligence, it falls apart because they found out these things aren't really there. So it's better to go back and do an A plus and just call it what it is, and then you'll get to the investor faster because we're all on the same page. If it's not a B, then just call it an A plus, and we're going to do another round. But I will say that you get another shot at it, but you don't get 3 shots, 4 shots. You get one more shot at it, but you're going to have to make that work at some level. And some people, scale back the mission or the scope, or you just get more focused so you can declare victory on getting to the next level. But it may not be, the cancer cure of the world, but it's going to have good value anyway. But you got to make that second one hit. But it's very common to do that too.
Yeah, but so then my last follow-up question, a C plus or an A plus, I mean, you get, you can't really, you do it once, you do it twice, in between these rounds, but I mean, at some point it looks bad, right? And you want to just nail it the first time around, right? And there is a balancing act there, right? And even in, attracting investors to put into a plus round, if you already done one plus round, you're doing another plus round at a different stage, it still may optically look bad, right? Can you talk a little bit about that?
Yeah, if you sometimes things happen, like COVID happened last year, so it's really nobody's fault, but we still can't call it a B, so we're going to call it an A plus, and we're going to get going on it after COVID and so forth. So sometimes things just happen that you have to deal with, and investors understand that as well. One thing I think they will look at is if you raise a Series A, how did you use the money? And as you go forward, in the seed you don't hear that so much, but later A's and B's, you hear a lot more discussion about, okay, you raise that C to 500K, what exactly did you spend the money on? And they start to look at efficient use of capital, good decision making, appropriate stage of investment between sales versus development versus support, and they're not actually looking for, was it the most optimal? They're looking for good decision making. We weighed the options carefully. We made a decision versus, well, I just spent it, and I get that sometimes. I just spent it. I don't know what I did, but I spent it. So you want to demonstrate that you're making good decisions with this, and then sometimes life happens on top of that.
So these during that diligence process, they're like interviewing you and trying to just trying to understand the makeup of the team and how they come about a decision, because obviously you would be able to find those type of metrics on paper.
Well, typically you had a vision or a strategy, and parts of it turned out to be true, and parts of it turned out not to be true. Parts of the market, showed up and bought the product, and then other parts didn't show up and buy the product.
Yeah.
And they're looking not so much at how that happened, but how did you react to that? Did you, spend a year and a half trying to make it work, or did you shut it down after 2 months and redeploy the resources to something else? Which means you're on top of this, you're watching this, and if it's working, we're doing it. If it's not, we're out, and we didn't burn too much money on an effort that wasn't going to play out. And sometimes the markets change, sometimes we just get it wrong, and so they're just looking for good decision making processes around money. As money, investors are putting money in or investing money, and you're giving them business results out, and so you want to show that you have a track record of doing that, especially when we get to Series A plus, and B. You want to put that up there to demonstrate that you give me money, good things are going to happen, and we're going to make good decisions on this, and we have a track record. Let me show you how we've done that before. I know some investors look very hard at that. They go back through the past fundraisers to see what you said you were going to do and what you actually did, and they use that as a proxy for how this round's going to come out. And so you'll get more of that as you go along, I think.
Excellent. Thank you for your thoughtful response.
Thanks. Yeah. We're getting near the end of our time. Did anybody else have any questions they want to bring up?
I missed the first slide, but I was wondering how to get to before to get to A series. So it
So
would be like pre-seed, right? Like,
So pre-seed in my mind is I'm raising money for my idea, and I need 200K or 250 or some small amount to just get a basic idea, out there, prototype built, so we can do some beta tests and cohorts. And then when I have something that is MVP-ish, I can actually sell something. And now we're going to market. That's a seed, and now I need 500, 750K to go take this into the market and start to grow it. And then after I get up to about 3, 4, 500K of revenue going, and I've got a good growth story behind me, things are growing fast and we're coming up. I find a lot of our investors in that 500K to $1 million range because the valuations haven't gotten too far out yet. But you can see this is on its way up, and that's where a lot of investors want to come in. And now we're going to raise our Series A 1.5 to 3, 4, $5 million. It just depends upon how big we can raise it. The stock market's at a very all-time high right now. The numbers are very high compared to what they are at other times. So, today's market is a little different, or today's numbers are different because the market's very high. But now you're doing a Series A because now we've shown that we can grow this thing, and our product market fit is coming through the numbers because we're growing faster than 50% year over year. We're going at 60, 70, 100% year over year. This shows you're on the right track. You got product market fit. I can tell people all day I got product market fit, but if they don't see it in the numbers, I don't have product market fit. So you have to demonstrate that in your sales growth itself. And so those are the metrics of pre-seed, seed, Series A. And then once I get $2, $3 million of revenue, and I started thinking, okay, I got my path going up to 10. When you get to about $5 million, you start looking for that Series B round where I need $5 to $15 million to continue the path up to 50 or $100 million itself. So those are the numbers we use. People's mileage may vary because they have different paths. So what one person calls a Series A, another person doesn't. I try to take what the investor community is going to think of as a Series A itself. I've had people come to me and said, well, mom gave me a check, dad gave me a check, so I must be on my Series B now. And you can play that out if you want, but I always like to think, well, what does my audience want to hear? And they want to hear that if you're at a seed level, you just call it a seed raise. Doesn't matter who gave you checks, just call it a seed raise, because then you're mapping into what they're thinking for sure.
thanks for that information. But yeah, I do see quite the term different from every cohort or from everybody has their own little. It's almost the same. Actually, I just filed for C Corp Delaware. Because obviously a lot of these rounds they lure more investors. So I was like, okay, I need to start getting more serious. So last week is when I filed for C Corp. So
Great. Okay. Well, good. We're looking forward to seeing next steps with it. When you get there, let us know. Appreciate it. Are there any other questions before we wrap up for the day? Appreciate you guys coming out today. If you have any other thoughts, let us know. We'll send you the slides so you have them. If you need more information, check out 10 Capital's website. We have a great education page with a lot of e-guides and other tools out there on many topics. If you'd like to learn more about fundraising in general, we have the Startup Funding Espresso. If you go to our sister site, investorconnect.org, investorconnect.org is our site where a pop-up box comes up and you can get our Startup Funding Espresso, which is a daily email with a podcast behind it. You can either read it or listen to it. In the time it takes to drink an espresso, you'll learn something about startup funding and investing. And so it's a great way to start understanding the space. But with that, we'll go ahead and close it out, and appreciate you guys joining us today, and see you next time. Appreciate it.